So hello and welcome to the Personal Finance Masterclass. And today I'm going to be going through as much as I can kind of cover within about an hour, anything to do with mortgages. Not so much the house buying process. I'll probably do a separate one on that. And I have got a guide on that if you want to contact me, and I can send that over. Just drop me an email and I can fire a guide over. That's not a problem. But this one's all going to be about the mortgages or mortgages and how they're kind of structured, mortgage deals, terms, and things like that. So let's jump straight into it. The bits that we're going to cover off then, just make this a bit bigger. So why mortgage in the first place? So do you need one? And what the purposes of it are for. What is a mortgage? And essentially that it's a secured loan. And I'll explain a little bit more things around the types of mortgage deal and terms. When to get a mortgage and sort of a little bit on how to plan. How to get the mortgage, the sort of process around that, and then some of the tools and things that you can use along the way. So, why a mortgage in the first place? So, I always say to people, first, if you didn't need one, you wouldn't essentially have one. You would be relying on funding it yourself. If you've inherited one, you don't necessarily need one. But in most cases, for most people, to be able to own their own home, you essentially need to look to have a mortgage because it's such a large quantity of money up front that people are required to have. And this obviously enables you to be able to do that. You're essentially using somebody else's money. It also is a very good way of building long-term wealth and stability, essentially through equity. So, and I'll explain how this works in a moment. But ultimately, the longer you have the property and the more you pay down on the mortgage, and obviously you get the capital appreciation of that property, you're building wealth in quite literally bricks and mortar, so in a tangible asset. And it's also stability around family. It's stability around not needing to get kicked out from the property or the uncertainty around rent and things like that. And eventually once you've paid the mortgage off and you own it, that's where the stability comes. You can retire, you're mortgage free. Nobody's going to be booting you out or anything like that. So it creates that creates a bit more certainty. And then other reasons you might need a mortgage are you looking to invest in property directly? So if you're looking to invest in property directly, then yes, you will need. You don't necessarily need one because I've had some clients that have come to me with enough cash where they can purchase, and they've been in a great position to be able to purchase property outright, and that's suited their kind of outlook to investments and attitude to risk and other things. However, for a lot of people, and for investors, especially if you're doing it for your first property or looking to want to benefit from a thing called leverage or gearing that I'll explain in a moment, then a mortgage can actually be a great tool in being able to use that. So I've just put there, enables you to own your own home using somebody else's money. That's kind of a very broad nutshell of what a mortgage is there for. So this shows you a bit of a breakdown and a very simple kind of pictorial visualization of how it kind of works. So these blocks here, or the segments that I've got obviously 75% is leverage, which is essentially the debt you would have on a mortgage. And then the 25% would be what you physically own, and it's your money that you've put in. And as time goes on, the more you pay down, the less debt you're going to have, and the more equity you're going to build up. And I'll explain the differences between repayment and interest-only mortgages and a little bit around that in a short while. But ultimately, yes, the equity that you build up in the property is yours, or the deposit you've put in. It doesn't have to be 25%. It's just kind of a figure that I've gone with. You can put as low as 5. There is a very few amount of mortgages that don't allow you to put any deposit in. So you have to be, in most cases, if you want sort of the widest scope across the mortgage lending capacity and the wider playing field, let's say, then yes, you need to put in at least 5 and ideally 10% in a lot of cases. And there's a few other ways that you can do that I'll touch on right at the very end as well. If it's struggling with a deposit, which I know a lot of people do. However, yes, so leverage is the debt, so you're borrowing that amount, and then obviously the equity is the amount that you own. So just to give you an example of how this would essentially look in some sort of numbers and figures. Don't worry too much about the actual figures. I've just plucked these out of air and run the calculations on them just to get a bit of a rough idea. Some people prefer looking at the facts and figures, and other people just like knowing the concept. So, if you had a £150,000 in the bank, or you inherited it or something like that, and you wanted to own 100% of the property, you would buy 100% of the property that's worth 150,000. Now, if for the sake of needing a mortgage, if you had you only had up to 37,500, that would be 25% of a deposit, and the remainder 112,500 would be the mortgage, which would enable you then to fully purchase the property in its entirety. Now, there is other schemes out there. I'm not going to go into grave details, but you've got things like Help to Buy schemes previously, and you have things like shared ownership. So, Help to Buy scheme is where, if you imagine where I've kind of segmented that down to 75% is the mortgage, and then 25% you own. Well, a Help to Buy is kind of a way of slotting in another kind of loan into that. So it would be 5% that you would put the mortgage deposit in. 20% would essentially be the loan from the government, and then the remaining 75 would be the actual mortgage. The purpose of doing this is to facilitate to the lender that it looks like you're putting in a larger deposit, because essentially you're borrowing money from the government to bolster up your deposit to be able to put down to get a better mortgage deal overall. Now, there is kind of quirks with the Help to Buy schemes and other schemes out there that, when you actually come to pay the mortgage off, or you want to move home or pay the loan off, if you decided to move house or pay it off, it's always usually about 10%, 20%, 30%. I've done a recent remortgage for somebody who have paid down a 30% Help to Buy loan, and they're essentially going to be, the longer you leave it, the more it's going to cause a sting to you long term with Help to Buy, because it's done on a percentage that you own. So I'm not going to go into too much detail. If you want to have a separate chat, or anybody else wants to ask questions on repaying any of those or how those schemes work, I'll go into that. But this is just a broader picture about mortgages overall. And then you've got shared ownership, which would almost be where you split the property right down the middle, and you have 50% that you would rent and 50% that you could look to mortgage. Or it could be split where you actually stagger it slightly. So you own 60, 70, 75. The terms of how much you can own depend on your affordability and the scheme provider. But ultimately, you can kind of negotiate, well, I want to own more. And then over the time, you might be able to staircase up where you could actually own more of the property long term, to eventually, hopefully, own 100% of it. You just have to be careful with the leaseholds and a few other things around those types of schemes. But they can be very good for helping people get on the property ladder, build up some equity and savings long term, and then it means that then they can transition into purchasing their own property through a more conventional type of mortgage. So the other one I've just gone on to is how it would work over the long term. So as you can see, 150,000. If the property increased over, say, 7-8 years or so, or 10 years, and it went up to 250,000, and the amount of profit you've essentially gained on that is 100,000. Well, on 100% that you owned, you would obviously get 100,000 on top, because now your property is worth 250,000, not 150. But the kind of clever thing that people kind of overlook sometimes is that you still benefit from the full capital appreciation of the property, meaning, as it's appreciated, you're still going to get that benefit of the 100,000 if you come to sell, but you've not had to put all of the money in up front. So it's something that it's a way of essentially leveraging or borrowing somebody else's money to make more of your own money long term. So it's quite a clever tip, really, and how a lot of previous generations have built long-term wealth through property, through residential property and buy-to-lets, because of the way that they're structured and the way in which the loans and everything can be arranged. So I've just explained there, you still benefit from the £100,000 profit without the need to put in 100% of the money to eventually purchase the property. Now, you've got to factor in fees and other things as well, and interest rates. However, this is just a kind of high-level overview of how that can be of a benefit to you, really. Another example is more for the investors because I've got clients that I've got a couple of buy-to-lets or buy-to-let portfolios. And this is an example that if you had £200,000 in cash and you put that into one property and the property increased by 10%, you would then have £20,000, which is obviously 10% of 200,000. Whereas if you took that 200,000 and you segmented that out across four properties, putting in a £50,000 deposit on each, it means then you own a bigger spread or value of property. And because I said that you benefit from the full capital appreciation, even though you don't have all of the equity in the property, this is where the leveraging can be very powerful, because then a 10% increase across four properties that you've split your money over is then 80,000, not 20. So again, something that can be very clever, very niche, and that's where a lot of people will then look to refinance property, pull equity out, buy a move on and purchase other properties, and kind of build up a portfolio over a number of years doing it that way. If that's something that would be of interest to you as a person, really. So I hope that makes sense. And then the other thing I always say to people is, what's the alternative? So if owning a home is obviously a priority and you're not wanting to get kicked out, you have to kind of think, well, a mortgage is kind of, I don't want to say necessary evil, but it kind of is a necessity for you to be able to purchase that home, because unless you can have money from parents or inheritance and be in a great position to be able to do that, or built up enough savings yourself, then when you're obviously younger, it's a lot harder to do that than when you've had time on your side to generate a bit more money. But again, life always throws you curveballs. So you have to kind of think, what's the alternative? And the only other alternative, really, I suppose, is renting. And you have to kind of balance it. Well, are you comfortable renting and putting that money aside? Some people view it as dead money. Some people like the flexibility. It's completely independent of each other, really. It's up to whatever your kind of outlook on it is, really. Owning a long-term stable asset that appreciates, that you can then use that money later on. You can downsize and release equity. You can then pass down to children. You've got more flexibility with that. Whereas obviously with a renting property, it's money that's going to pay off somebody else's mortgage. However, it again does give you that flexibility to move about if you're sort of in between things, or your job requires you to be in different areas. It's situational dependent, really, and I've not got a sort of bias either way. It just depends on what your personal circumstances, and if you've managed to pull enough money together and actually create enough money for a deposit and things like that. So what is a mortgage itself? So is a bit of some words that I googled, and obviously when I was studying, I knew exactly what the term means. But essentially, it means death pledge. So nice and cheery for you. But ultimately, it's just that it's either going to get paid off when it's fully paid off at the end, or the only way to get the debt completely settled, the other way, is obviously passing away. So hence why it's called death pledge. Obviously, you can read the wording specifically where it comes from. The only thing I would say with this is, if you've bought a mortgage jointly, so there's two of you on it, and one person passes away, the other person is then going to be liable for, in a lot of cases, 100% of the debt if it's a joint mortgage. Now, if it's a tenancy in common, which is a different way of structuring things, then it can be a little bit different. But if it's a joint mortgage, a lot of the cases, if there's two, you can even have 3 or 4 people on the mortgage, and one person passes away, it's the other parties that are then 100% liable for that debt. So it's only if there was nobody else around and it was your own mortgage in your own name, and then you passed away, the debt essentially dies with you. So again, something to cheer you up with. What else is it? It's a secured loan. So unlike a personal loan where you essentially have you go to the bank or building society or a third party or a broker or something, and you say, I need this loan for X purpose. You take out that loan, and as long as you pass your credit checks and they sign it and they give you that loan. I always say that the security obviously is against the property, is much like when I've got a hire purchase on a car. You sign the hire purchase agreement and I've got the car, but you have to obviously pay that off. And if you don't or default on the payments, they can then take that car away. It's the exact same with the house. If you don't pay the payments, obviously that's where it can be repossessed, which is this big wording that you kind of see on the bottom of documents and anywhere else, and I see it all the time, and rightly so. Your home may be repossessed if you do not keep up repayments on your mortgage. So that's where that is alluding to. It's basically saying if you don't pay, we've got security, and we've got it written on the title deeds that we've got the ability to be able to take that property if payment is unable to be made. Now, even though it might seem that that's a negative, that there's the security there, the upside of it being secured against the property means that because there is some collateral for the bank, it means that they can typically offer slightly lower interest rates, which is why personal loans are a lot higher, because the risk is a lot higher for the bank. If they don't get the payment, they're going to have to try and send somebody around to try and recoup costs. If you've got a fully paid off car, they might be able to use that if there's other assets in the house. However, if you're in your property and that is your asset, they know that they'll be able to recoup the costs from that property if they were looking to sell. So that's why the interest rates can typically be a little bit lower than they would be for personal loans, and any other loans for that matter. So you can see it as a negative that it's secured, but the positive is it means that you've got an asset there that they've secured the debt against to keep the payments slightly lower for you. It's another reason why, as part of your mortgage contract, you actually need to have buildings cover in place, because if the property was to fall down or someone was to drive the car through it or something drastic, they want to know that they can get that money back on the property. So that's why you have to have buildings cover on the property. So even though it's very sensible to have, even if you didn't have a mortgage, it's there that the bank want to know that their asset is protected, and it's just something that you have to pay for doing that. Even though the house is legally yours, they've just got to charge against the property for the actual secured loan. So, difference between a repayment. So I'm going to go through like the repayment and interest only, and then a few differences on the actual fixed deals and how they work. So I'm just going to squiggle down some drawings that hopefully will make some sense. So firstly, you've got a repayment mortgage and a interest only mortgage. So repayment mortgage, believe it or not, most people think they are structured like this. So if this is your years, and then this is the pounds that you actually pay for it. Most people think an interest-only mortgage obviously goes down over time. Now, it does go down, but it doesn't quite go down in that particular way. It goes down in this kind of format. So it arcs in the sense that you pay a lot more interest over the first about 2/3 to almost 3/4 of the mortgage term. So you pay mainly interest, and then eventually you start to then pay off more capital. So at this point, at the very end, you'd be mortgage free, which is obviously the dream for most people, as opposed to needing to have any outstanding balance. Now, a interest only mortgage, and let's just say it's 100,000. Now, over that amount of years, this could be 30 years, 25 years, however long you actually need the mortgage term over. Bear in mind, with an interest only, however long or short you take it for is not going to actually make a difference to the monthly payments. Whereas a repayment mortgage, which I'll allude to in a moment, the longer or shorter you take it over will then flex and essentially stretch or compress your monthly payments based on how long you take it over. So with an interest-only mortgage, 100,000 that you have on the property as a mortgage, at the end of the term, you will still owe 100,000. Now, this caught a lot of, and I've spoken to clients in the past where this has caught them out, or previously been caught out by it, because they might have had things like endowment mortgages and not kept up with a repayment vehicle to make sure that this is going to be paid off along the way. Because you need to make sure that by the end of the term, you've got some kind of credible repayment strategy. So by the time this particular end date hits, you know that it's going to be settled. Now, if you're using a interest-only mortgage alongside a buy-to-let, it's not really it's not your main home. So repayment mortgages on the left here, they're for usually residential in most cases, and interest only typically get used for buy to let. So we're going to be investing in a property long term. And the reason being is because you're only paying interest and not interest and capital, the payments are lower, which means the rent can cover the majority of the mortgage payments. And then long term, it may be that you might actually get a little bit of cash flow from it. But also you're benefiting from the capital appreciation. So if the property you bought was 150,000, and when you sold it has doubled to 300,000, you know you've got the difference, that you've benefited from the capital appreciation over the years. And by then, £100,000, when inflation has the effects that it does, is going to be a lot less. So inflation in these cases, I know I've spoke about inflation working against you for savings, but it can actually work with you if you've got debt. And a mortgage debt is a great example of how it erodes, because that £100,000 not increasing, it's staying the same. And as money and goods get more expensive, that £100,000 actually in real terms depreciating slightly. So that's the difference between repayment and interest only. Again, this is usually for buy-to-lets, and then this is usually for your actual home itself. So you can interchange them. So I've got some clients that have a buy-to-let on a repayment because they've got no interest in getting some cash flow from it. They want it fully paid at the end of the mortgage term, so it's completely free of any mortgage because it's part of their wider retirement planning, let's say. And they want to know that the rent at that point, because there's no mortgage, they're going to be able to get all of the rent off the tenant, which is going to be towards their retirement planning. And then on the flip side, I've come across clients that have previously had those interest-only mortgages where they've only got, say, a couple of years left on the mortgage, and they've called me and says, Pete, I've still got 250,000, 150,000 left on my repayment mortgage. I need to try and restructure it in a way that I can actually afford to and pay it off. Now, when I speak to clients, if they're ever looking to pay down on to have a residential mortgage, I always say to them, if you're going to be living there and it's long term, repayment is the way to go. You don't want to be thinking that there's a large debt at the end to have to try and settle, unless we've got a very credible investment strategy and a repayment strategy that runs alongside the mortgage, so that at the end we can actually make sure that is settled off. And that doesn't mean banking on things like, I'm going to get some inheritance because there's no guarantee, or I'm going to get some money from a bonus from a company or something like that, because they're not really certain. And I've known far too many people have had money that they're expecting from inheritance, but then gets dwindled away because of care costs, and then they're left with a big, large mortgage, and because they're expecting inheritance to pay it off, and it's not quite worked. So planning in these instances is key to make sure that it's going to be settled, because we want it paid off as soon as we can, so that you've got that stability and long-term asset there as well. So that's the difference between repayment and interest only. Like I say, you'll have to excuse the squiggles, but I hope that kind of gave a very basic idea of what the difference is between repayment and interest only are. So now the different types of mortgage deal and how these can essentially be structured. So you have a fixed mortgage deal, variable, tracker, discount, and offset. So I always say, imagine mortgages like you're going down a bit of a fork in a road. First, you have to go, am I going repayment or am I going interest only? And then you come up to the next kind of fork in the road, and then you've got these signposts. So once you've decided one, you then go, right, what's the next thing? Do I need to go fixed, variable, tracker, or discount? And then from there, the next fork in the road I'll come on to shortly is how long you want the mortgage term over, and then other little aspects that you have to take into consideration as well. So what are all of these mortgage deals, and kind of what do they even do? So fixed mortgage deal first. So a fixed mortgage deal kind of does what it says in the tin, but also can be a little bit misleading. It's fixed for a period of time. So it doesn't mean that your mortgage is fixed for 20 years, 30 years, 35 years, depending on how long you've had your mortgage over. It means that that's the mortgage length over that period of time, but it's actually fixed for, and I've bullet pointed the typical different periods of time: 2 years, 3 years, 5 years, 7. You can go 10 plus. And I've only done one or two for clients for very specific circumstances where you have a lifetime mortgage. So, where it's a lifetime fixed mortgage, that is not an equity release mortgage, a lifetime fixed mortgage. So, how does that why does that benefit you, and what's the pros and cons of each, really? Well, having a fixed mortgage means that you're going to have, firstly, stability of payments. So you're going to know exactly what you're going to be paying over those 2 year, periods, or 3 or 5. And how long you decide to fix that for ultimately comes down to what is the stability that you need. If you know you're going to be living in a house for 2 years, but you're not sure what you're going to be doing after that, or your outlook on the kind of economic outlook of things means that I want to just assess it in 2 years, but I do want a bit of shorter term stability. Something like a 2 year is going to be more fitting. Whereas if, as an example, you're thinking, well, I'm pretty happy here. It's my kind of pretty much our forever home, but we do think interest rates are running higher, or we just want to assess things in 5 years, then a 5 year deal is going to be more appropriate. There's no right or wrong answer. There's no what should I do? This is it. When you speak to somebody like myself who's an advisor, we kind of drill it down and get to the nuts and bolts of what is going to be most suited for you. I've had one client that I remember that we did a mortgage for, and they wanted a lifetime fix. They actually came from a different country, and they were used to having so much instability and turmoil in their country, and it was just, they were like, if we pay per month and we know exactly what we're paying, even if the interest rate is quite a bit higher than what it would have been for a 2 or a 5 year deal, we're never going to move. We're happy to stay exactly where we are. And they were dead certain on it. And obviously I went through the risks of, if you wanted to move, there's going to be penalties and things like that you have to factor in. But that's when it could be suitable. So you do have to just weigh up the overall situation between different fixed periods. And you kind of think, well, what happens after the fixed period? So once a 2 year deal comes to an end, or a 3 or 5, at that point, you will then roll on to standard variable rate. So each lender has their own standard variable rate, which does vary depending on lender. So the 2 year deal ends, as an example, and then you would slip onto standard variable rate, where your mortgage payments typically see a bit of a hike, and you will then be exposed to whatever the lender decides to put their interest rates to. So if interest rates are going up, then you're going to get a bit of a sting. And typically if they're going down, you are going to benefit from that. But because standard variable rate, or SVR as it's known as, runs usually a little bit higher, you usually see a bit of a hike in payments initially. So that's why I've drawn that kind of line there with the dotted line that says remortgage, because typically about 6 months. 6 months is the earliest you could look to remortgage. And I always try and contact my clients 6 months prior to the deal ending, so we've got enough time, because that 6 month window is key to being able to find a new mortgage deal, get all the documentation together, sort everything else we need, and it gives us the most options available, and the most options in the whole of market across different lenders. The closer we get to that deadline of the 2 year or 5 year deal ending, the tighter it becomes, and it gets to a point where we have to start factoring in, well, we could switch on to a new lender, but it's going to take a couple of months to do that. And if that couple of months mean that you're going to be sat on standard variable rate, then we have to factor in those potential costs of doing that. And then it comes down to, well, what lender works a bit more efficiently and a bit faster, and there's a lot more varying factors. So the sooner you can get in contact with anybody or sort it out yourself, if that's the case, I always say 6 months in advance, which some people think is a little bit early. But if it's going to save you potentially thousands in your pocket, then that's the best thing to do ultimately. So that's a fixed deal. So it's key takeaway, it's fixed for a period of time and then goes to standard variable. And then you would typically remortgage onto a new fixed deal if that's suitable to do at that time. So going on to the variable mortgage as a whole, you typically don't select to go onto a lender's standard variable rate. You kind of find yourself on it. And I've come across clients that have been sat on standard variable rate for a number of years, not even realised. They've noticed the payments have changed, but they just thought that's what happens and they just stay with that lender. And then I've remortgaged them, moved them to a new lender, or selected a new rate with their current lender, which is called a product transfer, and actually brought their payments significantly down just by having a little bit of know-how and understanding the different types of mortgage deals. So it's worth checking if you do see your payments go up or down. Are you on actually a standard variable rate, and can you simply just restructure your deal to create a little bit more stability, or if anything, obviously save you a bit in the pocket as well. So tracker mortgage. Now you might be thinking, well, that looks very similar to a variable, when it is and it isn't. It does vary and it can go up or down, but it tracks a particular index. So the variable deal with a lender is just they pick an interest rate, and that is the interest rate that you would be paying. Whereas a tracker deal essentially handrails or tracks, in a lot of cases, and there's different indexes, but in most cases tracks the Bank of England, the base rate. So if you had a tracker mortgage, and these can be again for a couple of years, 5 years, 10 years, or you can have a lifetime tracker, so a period of time, it would then say, for instance, be Bank of England base rate plus 0.25. So if base rate is at 5%, you're going to be at 0.25% is what your actual payments are going to be, which means if Bank of England base rate comes down, brilliant, your payments are coming down. But if they're going the wrong way and going up, it means that your payments are always going to be 0.25 above the Bank of England base rate going up. So quite simple to understand because it just tracks the Bank of England base rate. However, the actual assessing whether that's most suitable for you comes down to whether or not you're comfortable with that volatility in the mortgage payments as well. Thing you have to think about with tracker ones as well is, have you got the headroom that if you decided to go for variable or tracker, have you got the headroom to be able to or can we stress test it in a way that it means that if they did go up, you're going to be okay and you're not going to be finding yourself struggling as well financially. So that's something else to factor in. Now, discount mortgage works almost in the reverse as a tracker. So instead of plus a percentage, it could be minus. So you're getting discount off, and you're getting discounted off the standard variable rate. So whatever the lender's charging for that interest rate, you're then getting, for example, 0.25, or it could be 0.5%, whatever. It doesn't, situation dependent on each lender. You're then going to be tracking that lender's standard variable rate, but then it's going to be discounted off. There's typically also a floor rate, so that your rate couldn't drop below that, because if you're going to get 0.25% below the discounted, or that is the discount below the standard variable, then they're obviously not going to let you go to zero or minus. It'd be nice if they did, but they'll have typically a floor rate as well. So if interest rates did drop so low, the lender's still going to be charging some kind of interest as well. So that's a discount rate. And then the last one is a offset mortgage. Now it's kind of a deal, but it kind of sandwiches itself between a bit of an interest only repayment and a bit of everything. It's kind of an oddball, really. It's essentially where you have a savings account from your particular lender that is linked to and tethered to your mortgage. So the solid line is your mortgage interest, and each time you make a deposit into that associated savings account that's linked to that lender, anything you put in there that you deposit, instead of earning, say, 2 or 3% of interest on a savings account, you just don't pay that on your mortgage. So it works out the same way as earning interest, but you're just not paying interest, because interest saved is the same as interest earned. So it kind of works in the reverse way, that you're just saving money on your mortgage interest. So the more you put in, the less interest you pay, until eventually you can pretty much cancel each other out. And at that point, when they do, the lender will essentially contact you and say, you've got enough in savings here to pay off your mortgage if you want to. You don't have to. and then you can then cancel each other out. The upside to an offset mortgage is if you want to get money back out of that account, you can take it out. Now, that will then bump the interest rate back up. But what it does mean is that you've got a bit of flexibility to start taking capital back from the mortgage if you need to use it for something. So if you've got a business and you need to use different capital, and your situation just means that you need some money, you can do it. You just have to factor in that that's going to then alter your payments per month on your mortgage. Unlike whereas if you had just a standard repayment mortgage or a fixed mortgage, if you're wanting money out of your property at that point, you're going to have to go through the process of additionally borrowing money or remortgaging or asking your current lender if I can borrow some more money, which is going to require applications and a bit more of a structured time frame. Whereas offset mortgage is a bit more fluid in that you can deposit and take money out for doing it. You do have to weigh up though, because the interest rate for offset mortgages, because of all these kind of moving parts, that typically run slightly higher than your other kind of standard trackers and fixed deals. So you do have to start weighing it up that, are you going to be able to actually make significant overpayments? And these are perfect for somebody that earns quite large bonuses. So if you earn a large bonus and you're able to put those into the offset mortgage to start benefiting from the payments coming down and saving on the interest, it can be great. Because if you start paying significant amounts off other types of mortgage deal, there can be penalties in place, like early repayment charges for fixed deals. And even though most of them, you have a set allowance, which is usually 10% of whatever your outstanding balance is, you can overpay. But if you're wanting to pay more than that, then penalties are going to come into play. So this, again, can be something quite beneficial for people that are receiving large bonuses or have capital that they want to put forward towards it. So let's just go on to the last one. So this is almost like the last fork in the road. So once you've established the deal and how you're going to structure it, and is it repayment? Is it repayment interest? Is it fixed variable tracker? What are we looking to do? Then you go to, well, how long do we want the mortgage term over? Because if we stretch the mortgage term as long as we can, the payments will inevitably be lower. However, although they are lower, the interest that you will pay over the length of the mortgage will be more, purely just because of the compounding effect that it has on that money. So the longer you take it, the more interest you're going to pay. The shorter you take it, the less interest you're going to pay. However, the payments will be compressed. Now, that's where if you had something like an offset, you've got a bit more flexibility because you could overpay and take money payments back. But we always want to make sure that the term is suitable for your needs or a client's needs. So we want to make sure that is 25 years, is that going to sandwich up to when you're going into retirement and you want that the mortgage is paid off at that point? Or is it that we need to take it a little bit longer because now money's a little bit tighter, so we can take it a couple of years to lower the payments to make it more feasible? Just granted that, we have to kind of say, well, the interest is going to be more on it. So you're not actually saving money. It just helps with the cash flow per month. So by stretching it out, you're not making a saving because it's a lower payment. You're just elongating the term that it's over. And again, by compressing it, you are saving interest, but then that's going to push up the payments, and you've got to make sure that's affordable for you to be able to do. So it is a bit of a balancing act of finding what the most suitable mortgage term is. And when you come to remortgage, whenever that might be, say if you did a 2-year fixed deal and you want to remortgage, if you're able to, you can fully restructure it at that point. So you could add more savings in, reduce the term. It's not necessarily the case that once you fix this mortgage in for 2 years, and I've done it over a 30-year mortgage, that's it. As long as it's still affordable and you pass credit checks, in a couple of years' time, you can then look to restructure things. So you do just have to make sure that you're proceedable to do that and that your credit score's up to scratch. But ultimately, you can obviously tweak and adjust things to suit. So when to get a mortgage? The ideal answer is never really. If you can avoid getting one, if you're going to be living there and you're a means have got savings, that would be ideal. However, like I've said, that's not the case for most people. I'm under no illusion that obviously, I have a mortgage. I know lots of the people that have mortgages, and actually, if you know what you're doing and you're structuring things correctly, like I've mentioned with the, using the leverage, it can actually work, for your favor because you're using somebody else's money to benefit from a larger capital appreciation long term. So it's not all doom and gloom. I would say plan now. So whether you're a first time buyer, home mover, or you're remortgaging, if you're a first time buyer, sooner's better. You can use different types of savings schemes like lifetime ISAs, different ways to build up money to get government bonuses. If you're a home mover, really planning out what equity you have in your house at the moment, what's the sale price, and finding out all the fine details, because some people can underestimate how long the process can take. And obviously finding a house, the sooner you know the figures, the better you're going to be to be able to sit in the driving seat. And when remortgaging, I've already mentioned at least 6 months before. It could be that you could remortgage. There's no 6 months before a deal ends. It could be the middle of a mortgage term, or it could be 2 years into a 5-year deal that you want to remortgage because you want to borrow more money to do home improvements. All of these other things factoring in, but planning is obviously is key to making sure you get all the facts and figures, and making sure you've got the best solution for you, because you don't want to be leaving it last minute. And then obviously being dictated to by what lender you've got to go to and what your situation may be. The sooner you can save and plan is going to have a profound effect ultimately. Things to keep in mind whenever you're, first time buyer or home mover or anything is, the costs that are associated with remortgaging or with purchasing. So you've got advice fees potentially. You've got solicitors' fees, estate agents' fees, surveys. All of these things you need to factor in. So once you know, and if you speak to a good financial advisor, they'll be able to kind of help you get to the bottom of what those costs are going to look like, and even potentially get quotes for things for you to say, right, this is what it's going to look like, and factor that into your plan. So not just arrange a mortgage and say, well, sort out the rest yourself. I always say to clients, you need, we'll figure out the mortgage, but then if they've got, 20, 30, 40,000 pounds saved, I'm like, well, we need to allocate some of that to cover these fees as well. We can't just lump it all into the deposit. So we kind of start breaking it down and putting them into separate pots to go, right, that's to pay for that and that's to pay for that, to really plan things out. So you're not just left having to try and juggle things and hoping that the money's going to fall out of thin air. Give yourself enough lead time. I've hopped on about that. Things to think about is, will it be your forever home? Or are you upsizing? Or are you sort of wanting to downsize if kids moved out? What's the situation? All of these are going to be key into knowing what mortgage term deal that you're going to be taking as well. Because if it is your forever home, then you can afford to take a longer fixed period. But if you're wanting to downsize or move, you're going to want a little bit of flexibility with that as well. Or is it a geographical change due to jobs or just personal circumstances that you're moving? How's that going to have an effect? And then do you need any additional funds as well? So if you're looking for home improvements, there was a lot of this over sort of the pandemic and other things. People had a lot of time and were able to do home improvements, so we're raising money against their mortgage to be able to do garden sheds, or a lot of people working from homes or home offices, or converting garages, all of these types of things. You don't necessarily have to be upsizing or moving. It could be a case that you just improve the home that you've already got by having an extension or something like that as well. So they're just a few things to think about when you're thinking about the time frames. And when it comes to planning, because I've not really gave a specific time frame, if you're employed, everything's always sooner is better. But if you're employed, you're typically only going to need less time frame to plan than you are when you're self-employed. So if you're a sole trader or limited company director, you're going to want to plan ideally a few years in advance, because lenders look at your accounts, not just your last 3 months pay slips. Like an employee, you would look at your last 3 months pay slips, or 6 months if you've got commissions and things, or it could be 12 months if you've got bonuses. Whereas when you're self-employed, they'll look over the last 3 years of your accounts. So has it been profitable? Has it been steadily increasing, or has it taken a dip? Do they need to average it? So the sooner you're planning to make your accounts reflect more positive towards a lender, which can be done by not expensing loads of things out, running lots of expenses through your company. Yes, you're going to be paying more tax, so it kind of goes in conflict with what an accountant would typically tell you. But when it comes to planning a mortgage, it needs to be a profitable company, or you need to be a profitable sole trader for a lender to look at it and go, yeah, that's exactly what we're going to be able to offer a mortgage on that for that person, because your company looks sustainable. So that's the way in which planning years ahead has a profound effect. And does age affect what mortgage you can get? Well, yes. Ultimately, you have to obviously be of a minimum age, but the age in which you can get a mortgage up to has increased over a number of years. So you can, in some cases, go up to, for a typical residential mortgage, you could go up to maybe 85. Not that you ever want to, if you can avoid that, but it might be that then it means that you can actually afford to make the payments, and you're not having to sell the home if you're looking to remortgage, or if you found yourself in a pickle because you've got an interest-only mortgage and you need to restructure that, and it means that taking it longer means that your new repayments are slightly lower, and it means that it's feasible. That's perhaps one way. At those points, you have to start looking at things like what pension income you're going to get. You're going to get a full state pension, to make sure all of those parts actually come together, to make sure that when you finish working, it's still affordable, because you don't want to be paying a mortgage in retirement if you're not able to sustain it. But ultimately, a lot of the time, you are really wanting for it to be paid off as part of your retirement planning. So when I speak to clients around, where what their goals are and what their objectives are, you really want to make sure that their mortgage is very much fundamental to their overall retirement planning. So if they're going to save 500, 600, 700 pound, £1,000 per month by having the mortgage cleared, that's going to free up a lot of money, which means then perhaps their pension pot doesn't need to be as strained as much as well. So you do have to balance those out. So yes, it does affect it by your age, but it's typically a little bit longer than a lot of people think that you can go up to. Doesn't necessarily mean that's the right thing to do, but it is an option that's there if it means that's the only direction we can look to take things, really. So how to get a mortgage? So you have essentially three options. Speak to somebody like myself, financial advisor. Obviously, I've alluded myself to there as a bit of a hero. And then you've also got go to the bank or building society, which could be your own bank or a different bank that you've sort of walked into, or you've got do it yourself. So pros and cons of each, really. Financial advisor, make sure that they're whole of market. Not all financial advisors or mortgage brokers, mortgage advisors are whole of market. They can work off a panel. So you do have to make sure that you do actually they have access to as many lenders as they physically can have, because it means that you've got more options available to yourself. Usually they do charge. I charge for the services that I do, because I know to the level of work that I work to. And you only ever deal with me or my PA. Then you've got go to a bank. Now, upside is with a bank, you're typically not going to charge for it. However, you're only going to be limited to that bank. So if you went into Halifax or NatWest or HBC, whoever it is, and you walk in, you speak to their mortgage advisor, they will only be able to advise you on just their mortgage products, which means that you're missing out on the other plus 60 odd different lenders that are going to be out there that you can actually, you could potentially be losing out on, which means that you could be costing yourself thousands. So that's where an advisor can really come into their own with doing all of that mortgage research. And if you're able to do this yourself, or you could do a bit of a part and part, if a client wants me to do the research on finding the actual lender for them, to go, right, that's your solution. I've checked your criteria. It looks like it all works. And then I essentially pass it off onto the client for them to process themselves. Most cases, that's the bit that they struggle with, but you could do that. Or if you've got enough know-how to actually scour the market and research yourself. Granted, most advisors are going to have tools, research tools, and things to be able to calculate, compare costs, and also to research lots of different whole of market options. Whereas trying to do that manually can obviously be time consuming. But if you've got the time, you've got the know-how, all power to you to be able to do it as well. And then you know how to actually process that, what documents are going to be required. Do you fit their criteria? Do you pass their credit check? All of these parts you can look to put into your plan and do it yourself, and then ultimately facilitated doing the mortgage. So there are kind of three options really that you could and where you could sort of go with that. Again, you've got advisors that sit within estate agents. Again, just check whether they're on a panel or not. You've got completely people independent of any estate agent or of any company. I work independent of anyone myself. Or there's other advisors like me out there. So it's finding somebody that you trust, that does the job right for you, that's going to listen to what you need, make sure that it's structured correctly for you, and not just go, oh yeah, 2-year deal's fine. Actually question it and go, right, what are you looking to do? What's your outlook? How does your job and your future prospects look, and factor all that into your sort of planning process as well. Not just facilitate a mortgage for you. Then we've got, this is the process overall. So, by all means, take a screen capture or whatnot. I've pinched this from my own guide, mortgage guide or purchasing guide that I created. So again, if you're wanting this, just drop me an email and just put in there, can I have the guide, please, or something like that. But ultimately, it's the process that you follow. So, whether it's speaking to an advisor or going into a bank, this is typically the process that you would follow. So you would speak to somebody, ask any questions, see if you like them, how do they work, how do they charge, and chat through the process. It's just that kind of initial consultation to make sure, when I do it with my clients or potential clients, make sure it's something that I can help them with, and I understand their situation. Then you book an appointment and you have to go through, documents have to be reviewed, you collect information and discuss options available. So that's where we really start to get to the nitty gritty of what the lender is, and I'll basically go and do all the research on it. Then we can look to get a decision in principle, so a credit check. At that point, once we know what lender we're going with, we can get a credit check. And it's at that point that if you haven't found a house or you're not remortgaging because you're a first-time buyer or a home mover, that's when you'll have the decision in principle certificate to be able to go and show to estate agents to know exactly what you can afford, and to make sure it's proceedable and you've passed the initial kind of hurdle. And then I would then, or an advisor would then present this back to you as the client, you as the end person. You would then sit down and we would go, right, this is the payments, this is the interest rate, these are the fees associated with the mortgage, because there is different types of fees that are associated with them, and making sure that it's the most cost-effective solution, as well as making sure we've arranged any insurances. I've already mentioned builders insurance earlier on, but life insurance, critical illnesses, income protections, family income benefits, there's all these other bits as well that we need to have a conversation around, that we're pulling together to make sure that you're obviously covered alongside the property, because it's such a large debt you're going to be taking. We need to make sure that you're covered along the way with it as well. Then we go on to, if you were to go, yeah, Pete, that is brilliant, we want to go and get that moving, we found our dream home, we're happy with the recommendation that you've made, can we get that put in place? So then we would then get the applications underway. We would then submit those to the lender, submit any required documents, so bank statements, pay slips, any budget planners that we needed to do with the lender, obviously the full application that goes into the lender, and anything else as well. So, and submit any insurance applications that we need to alongside it. Then we would wait a number of days. Could be, sometimes these have come back really quick, and other times they can take up to about 30 days or so. So it just depends on the lender, how much strain those are under, and how complicated your particular situation is. Then you would look to get, hopefully obtain a mortgage offer. So they'll either query extra questions and come back and say, can you provide us more documentation? Or they're going to assess it. The underwriter is going to assess the case. A valuer is going to go out to the property you want to purchase or you're remortgaging. And they will essentially, from that, make the assessment and release the mortgage offer. And then from there, you would then make sure that all the legal work and everything is kind of teed up. So you would want to make sure that you've got legal the conveyancers in place or solicitors in place to be able to act on your behalf that you would have had instructed prior to this point, that almost run parallel to the mortgage process, and they would do all their searches and checks and land registry searches, check the mortgage offer, request funds, and do all the bits they need to, which would then head you towards completion. I'm not going to go into too much on the legal bit because this is mainly around mortgages. Again, there's a bit more information that I've got in the guide if you need to know more detail around that. You just need to make sure that the solicitor works with the lender and vice versa, because sometimes they're not always on the same panels as each other as well. So that's the process, the mortgage process predominantly. And then what are some of the tools that you could use along the way? I've kind of mentioned most of these as we have gone, to be honest. You've got lifetime ISA. So lifetime ISA is a government. You essentially get a government bonus from the government towards your savings. So you put an amount in. It can be up to £4,000 a year. So between April and April, £4,000 to get a 25% bonus, which is obviously £1,000, to then top that up. So that would be topped up to 5,000. You could do that each year. It starts to be quite powerful if you're doing this. £1,000, 25% bonus is quite a nice uplift that you can use. So if you haven't saved towards a house and you're a first-time buyer that these are most applicable to, you can't be if you've already owned a home and things, you can't necessarily use it for that. You have to use just save the hard way. But these are for first-time buyers specifically that I would, and if you've not had one previously as well, they're the main people that are going to benefit from this to help them get on the property ladder. You did have Help to Buy schemes, which was the older version of lifetime ISAs, which you can't get now. But if you've still got one, you can still use them. You can even transfer these into lifetime ISAs as an alternative if you wanted to. But they just boost your hard savings to try and get you there a little bit quicker. Then we've got other things which, again, I know in an ideal world would be nice if you can get things like gifts from parents or relatives or guardians. I'm under no illusion that that's not for everybody. It's just coming more and more pertinent with more and more people that I speak to, that they're relying on parents and guardians to be able to give some kind of gifted deposit, or to kind of jump to the very bottom one, adding multiple people on a mortgage. You can have like joint mortgage and sole proprietor mortgages, which is where you have multiple people on the mortgage, but only say two or one person actually owns the property. Some people think of it as almost like a guarantor mortgage. It works a little bit different, but if that helps you understand what it's like, it's very similar to that. But you've also got the straight up gift. If a parent can give you a straight up gift towards a property and they have to write a declaration sort of gift form to say that they're not going to want that money back in the future, that can be obviously a massive benefit. And I've spoke to a lot of parents alongside appointments with things. So I've chatted with the parent, chatted to the person purchasing, to make sure that everybody's in understanding of how that could work. And then obviously you've also got things like inheritance as well that could be something. If you've inherited some money, you can use that towards deposits as well. So it's quite hard to kind of predict things like, am I going to get a gifted thing from parents? Am I going to get inheritance? So obviously making your own provisions is first and foremost most important, and planning out and having some kind of lifetime ISA. You can use things like Moneybox or I think Skipton Building Society do a couple of or different sort of lifetime ISAs that you can look to save into. There's many more out there. That doesn't necessarily mean you have to go for just those. Or you speak to an advisor, again, like myself, and we can help arrange one. But ultimately, just having something, a tool towards that saving for that deposit in a lot of cases can be it. Now, if you're remortgaging, you're not having to worry about that at all. You can simply just use the equity out of the property. And as long as you've got enough equity to carry forward to the new property, that is your deposit. So you're not having to save anything extra, but you still have to factor in fees and charges as well. So that's what to watch out for. So just to close then, this is the summary that I've sort of gone through. So why a mortgage, what is a mortgage, how to get a mortgage, and how to get a mortgage, when to get a mortgage, and some of the tools as well that can be used along the way. So hope that has been of some use. and that can make some sense. If you've got any questions on anything or wanting to have a bit of a chat, by all means, reach out and drop me either a message on Facebook, Instagram, or wherever, or you can just drop me an email as well, and I'll be able to answer any questions that you may have. So hope that's been helpful, and thanks for watching, and I hope to catch you in the next one.